Veritas are a relatively small boutique UK investment manager. We were established in 2003 by myself and my partner Charles Richardson. I head our global equities franchise. One of the funds that I run in that is the Veritas Global Focus Fund, which, as you know, is the Nedgroup Global Equity Fund, which we run. I have a team of 7 analysts who work with me. Those analysts are mixed by way of either sectoral coverage for 3 sectors, which is healthcare, technology and financials, or the rest are just roving analysts. We look to invest in high quality companies for the very long term, so our average holding period is 5 years or more. And we're looking to invest in those high quality companies when they're attractively valued and obviously hold on to benefit from the compounding of their earnings and cash flows. And it's a relatively concentrated fund. Typically have 25 to 30 positions across the fund, and it's all mid to large cap. So our minimum position in terms of market cap would be 5 or 6 billion US dollars, all the way up to the mega caps. So it's a very liquid fund. The biggest sector or area that's been a performance driver for us has probably been aerospace. So we have some quite big investments in aerospace. We own Airbus, which is the airframe manufacturer, which has a duopoly with Boeing. We own Safran and Rolls-Royce, who are both engine manufacturers. Safran are engine manufacturers in short haul, and Rolls-Royce are engine manufacturers in long haul. There's only 2 manufacturers in each part of the market, so there's 2 long-haul manufacturers and 2 short-haul manufacturers. Great oligopoly markets, they perform very well. Demand for aircraft is constantly rising. Airbus have a 10-year backlog for their short-haul aircraft. So there's a wonderful order book for these companies. They're very, very cash generative, so they performed very well for us. In other areas, it's a bit more mixed. So healthcare, we've had mixed performance. Some have done very well and some have done less well. Interestingly, one of our bigger positions has been cable, US cable companies. They performed well maybe 18 months ago, and then for the last 12 months, up until kind of September 2018, their performance wasn't great, partly due to some concerns about them losing video subscribers. As those video subscribers move to the likes of Netflix. More recently though, their performance has really started to turn around as people can now see the cash flow generation coming from these companies. Their capital expenditures are declining as they've spent a lot of money on the network, so they don't need to spend quite so much money on the network. And their subscribers for broadband are growing quite strongly, and so we're seeing a huge generation of cash flow from these companies, and so their share prices are now beginning to react. In terms of equity markets, we're not macro investors, so we're macro aware. Obviously, we keep an eye on what's going on from a macroeconomic perspective, but we don't try and make a call in terms of macroeconomics. So, we look at things like the trade war and the level of the dollar and anything like that, and we'll take a view, but we're not trying to invest based on that. So what we tend to look at is more fundamentals. So we look at valuations of companies, growth rates of companies. Now, one of the things we've been doing as a team is looking at our investments, and obviously we're long-term investors, so we're looking at 5 to 10 years for all of our companies. And we're trying to assess how well they would perform in a recessionary environment, because we're 10 years into an expansion, and we have to think that in the next 5 to 10 years from where we are today, there's likely to be a recession. And so we're trying to work out which of our companies are likely to perform well or better than average in a recessionary environment. Where we think that valuations might discount a recessionary environment. So we're looking for those kind of things because we do think in the next 5 years that there's likely to be some form of recession, however shallow. And at the same time, we obviously look at valuation indicators. Valuations have pulled back a bit. So towards the end of last year, as you know, markets declined. That led to valuations coming back somewhat. They're still at the high end, though, of fair value, so they're certainly not cheap valuations as a whole, but they're equally not egregiously expensive. So we have managed to invest a bit in the fund during December when markets fell. We used some of the cash that we had about 10% in cash, so we put some of that to work in investments that we think will do well over the next 5 to 10 years. And then going forwards, we have some areas within the fund that I am very hopeful of and very confident of. So we just touched on cable previously. Those companies are generating huge amounts of cash flow, and that's likely to continue over the next 4 or 5 years. They will use a lot of that cash flow to buy back shares. And so the per share growth rates in those companies are very rapid, particularly in free cash flow growth. So we think that those share prices will react very positively. And we have big positions in the cable companies. We also have a few healthcare companies, particularly in the healthcare supply chain, where the performance hasn't been brilliant. It hasn't been terrible, but it hasn't been brilliant, kind of in line with the market or maybe slightly worse. But where we think over the next 3 years or so, we will see a resolution of drug pricing in the US, and we actually think that that will be positive for the supply chain. And so we think we've got good positions that will expose us to that. So we think overall, we think markets could be quite difficult based on the fact that over the next 3 to 5 years we probably have some sort of recession, and that valuations today are not cheap. But equally, we're quite confident in a lot of the holdings that we have that they will perform well almost regardless of the economic environment.